Payroll-related taxes in Denmark are often perceived as complex, but with a clear structure and disciplined processes, employers can navigate them efficiently and with confidence. In this video, we will walk through the essential elements you need to understand as an employer, the core components of payroll in Denmark, key tax obligations, mandatory employer contributions, reporting requirements, and a few practical points on governance and compliance risk. This overview is aimed at HR leaders, finance managers, and executives responsible for Danish entities, whether you are newly entering the market or looking to validate your existing setup. To begin, it is important to recognize that Denmark operates a highly digital, integrated tax and payroll environment, anchored around the CPR number for employees and the e-income reporting system managed by the Danish tax agency, Skattestyrelsen. Employees are primarily responsible for their own income tax, but employers act as withholding agents and as the main conduit for a number of mandatory social contributions and labor market schemes. From an employer perspective, payroll costs can be grouped into three broad buckets: gross salary, statutory employer contributions, and withholdings you administer on behalf of the employee. While headline personal tax rates in Denmark are high, employer-side statutory contributions are more moderate than in many other European jurisdictions, which has implications for cost planning and reward design. Turning first to income tax withholding, Danish employees receive a tax card from the authorities, which specifies their withholding tax percentage and personal allowances. Employers must obtain this data electronically through the government systems and ensure that the correct tax, or income tax withholding, is applied each pay cycle. Failure to use the correct tax card, or defaulting to a standard rate without justification, can create underwithholding risks and subsequent compliance issues. In addition to income tax, employers are responsible for withholding the compulsory labor market contribution, known as AM-bidrag, typically 8% of gross salary, which is deducted from the employee's income before other taxes are calculated. Although this contribution is technically borne by the employer has a legal obligation to calculate, withhold, and remit it, and any errors will generally be addressed first through the employer. Alongside income tax and AM-bidrag, employers must also administer ATP, the Mandatory Labor Market Supplementary Pension. ATP is a relatively modest, low-cost scheme, but it is compulsory for most employees and paid partly by the employer and partly by the employee. The employer's share is higher than the employee's share and is paid as a fixed amount depending on hours worked, rather than as a percentage of salary. Ensuring that employees are correctly categorized as full-time or part-time, and that ATP contributions align to actual working hours, is essential to avoid underpayments and retrospective corrections. Many employers in Denmark also participate in additional pension schemes, often through collective bargaining agreements, where employer contributions can be materially higher. While these are not taxes, in a narrow sense, they are a core part of payroll-related cost and must be integrated into your total compensation planning. Beyond these core items, Denmark has a set of statutory employer-paid contributions and insurance-like schemes tied to labor market protections. The most notable include contributions to industrial injury insurance, maternity and paternity reimbursement schemes, and, depending on your sector and any collective agreements, contributions to holiday and training funds. Some of these payments are handled through REFUSION systems, or via designated funds, and the rates can change periodically, which makes it important to monitor regulatory updates and ensure your payroll provider or internal team keeps configurations current. You should also pay attention to the rules on sickness benefits and reimbursements from the municipality. While employers typically continue paying salary during periods of short-term sickness, they may be eligible to claim reimbursements after certain waiting periods, provided documentation and reporting requirements are met. This link between HR processes, time and attendance tracking, and payroll reporting is central to controlling costs and staying compliant. A specific area that often creates complexity is the treatment of fringe benefits and allowances. Company cars, free telephone, internet, housing, and certain travel and meal benefits can be taxable in Denmark and must be correctly valued and reported as part of the employee's income. As the employer, you are responsible for identifying which benefits are taxable, ensuring their consistent valuation, and including them in the payroll reporting to Skattestyrelsen. Misclassification of benefits as tax-free, or failure to report them, can lead to reassessments, penalties, and reputational risk, particularly in an environment where authorities increasingly use data analytics to identify anomalies. For international employers or those with cross-border employees, additional complications arise. If you have employees commuting from neighboring countries or working partly in Denmark and partly abroad, you need to determine whether Danish tax withholding applies, whether social security is covered under EU regulations or bilateral agreements, and how to coordinate reporting to foreign authorities. Mistakes in this area can affect not only employer liabilities but also employees' access to social benefits, which can become a sensitive employee relations issue. From a process and governance perspective, effective payroll compliance in Denmark rests on 4 pillars: accurate data capture, robust system configuration, timely reporting, and clear documentation. Accurate data means having complete and up-to-date personal data, tax card information, contract details, and working hours. Robust system configuration involves aligning your payroll engine with current tax rates, contribution rules, and any sector-specific requirements. Timely reporting is anchored in monthly submissions through the e-income system, with strict deadlines for paying withheld taxes and contributions. Late payments can attract interest and penalties. Clear documentation, including employment contracts, collective agreements, benefit policies, and payroll procedures, is your first line of defense in audits and internal reviews. It is also advisable to establish internal controls such as periodic reconciliations of payroll ledgers to tax and contribution payments, review of exception reports, and regular validation of master data. If you work with an external payroll provider, you should formalize roles and responsibilities, ensure you have access to underlying documentation, and conduct periodic performance and compliance reviews. Ultimately, the goal is not only to avoid penalties but also to provide a predictable and transparent experience for employees, where pay slips are accurate, questions can be answered quickly, and there are no surprises at year-end. To conclude, payroll-related taxes in Denmark require a disciplined, structured approach, but they are far from unmanageable. By understanding the core elements, income tax withholding, AM-bidrag, ATP and other statutory contributions, the treatment of benefits, and the integration of HR, time, and payroll data, you can significantly reduce compliance risk and enable more reliable workforce cost planning. Organizations that invest early in sound processes, capable systems, and clear governance typically find that Danish payroll can operate smoothly in the background, freeing leadership to focus on talent, productivity, and long-term value creation. If you are setting up operations or reassessing your current framework, consider a detailed payroll health check against these areas, and ensure that your practices are aligned with both current legislation and leading market standards.